Hello everyone. Hope all of you are doing fine. Let me take you through the fixed income outlook for the month of March 2023. CPI in India came at 652, while the headline was significantly higher than the expectation. However, the core was at 610, which was in line but slightly elevated. The GDP data for Q3 came at 440, marginally lower than the expectation. However, for FY24, our headline CPI trajectory seems to be in the band of 5 to 5.5 and GDP at 6. Inflation doesn't seem to be in the red zone and GDP growth risks are evenly balanced. Now comes the tricky part. We are in a situation where our house is in order while the external world seems to be at a larger risk of macro instability in the US and the EU, geopolitical instability in Russia and to some extent China. As the data is coming stronger than the expectation and inflation is still much higher, hence the Fed is expected to keep pursuing the rate hike cycle. Now the question is, how long? Market is pricing in Fed rate hike of 5/4 to 5.5 and cuts to begin later in 2023 or 24. However, the Fed may decide to move till 5.5 to 5.75 and remain at pause for the CY 2023. This seems to be like a situation where we are in a jungle and there is a fire. Then what happens? Of course, all the animals run away, except one. Any guesses? Who is it? It's the rhino. The rhino is known as the firefighter of the jungle. Once there is a fire, it quickly runs and stamps it. When we draw the same corollary in the fixed income market, inflation is the fire which takes away the return from the jungle of bonds. Do we have a firefighter? Yes, we do. FRBs or the floating rate bonds are the rhinos of the fixed income market, protecting against the impact of inflation. How it happens? In a fixed coupon bond, the coupon remains fixed for life, while the floating rate bond coupon keeps moving in line with the benchmark. Given the attractive spread over the benchmark, FRBs are very attractive now. Yield curve has turned extremely flat, making 2 to 6 years very attractive on the yield curve. Friends, we are still in a hiking season. However, peak of rates seems to be near. We expect long-term yield to peak out somewhere in the next quarter, as most of the events either will be done or priced in by the market. Difficult to say at what levels though. Currently, the FRBs on a hedge basis are offering 8.15 for the 10-year versus 7.45 for the traditional GSEC for the same maturity. Hence, mix of long-dated FRBs 2033 and 34 or 2 to 6 year GSEC offer optimal portfolio mix on a risk-reward basis. We have started hedging our positions in the FRBs given the attractive fixed levels, and we'll keep doing the same as appropriate over the next few months. We recommend investors to invest as per their investment horizon. However, they can consider short to medium term actively managed duration funds or target maturity funds as per their risk appetite. Thank you. Stay safe, stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.